In this week's update, index bear market is reinforced. Laser focus on opportunities is the key. And the Australian dollar gold price closes in on $5,000. My name's Garry Davis. I'm an authorised representative of Primary Securities. The information presented here is general information only. Market status last week, things looked better for a couple of days, and then the market got clobbered in the US, and we'll certainly see, I would expect, some sharp falls here on Monday. So when you stand back and look at what's happened over the last month, 5 weeks, tariffs are undoubtedly the trigger. However, a valuation reset was required because the US market was very expensive. It had run ahead of itself, and people have been talking about this for a couple of years. And sometimes that's just the way it goes, that it takes a long time and the market has to get extremely overvalued to get that valuation reset. But make no mistake about it, this is really a situation of buyers were exhausted and sellers were ready to sell. There were a lot of smarter money that was ready to sell, and the tariffs were just the trigger that they were looking for. It caused the buyers to hesitate, and then the sellers streamed in and everyone else has jumped on the valuation reset bandwagon. And that'll play out now until the balance of players feel that the selling has gone far enough, some value is returned, and the buyers will come back and the sellers will go away. So there's nothing mysterious about what's happening. You just need to realistically recognise what is happening in the market. It's just this balance between buyers and sellers. And the more that you can look at the market through that lens and not look for a whole bunch of other spurious reasons so that you can get some magical insight into what the market does next, I mean, it's pointless because no one knows what the market's going to do next. It's just a waste of time. Just recognise that we get shifts between buyers and sellers and you manage risk accordingly. Having broken down, and now we've got the sellers well and truly in control, it is likely that will overshoot to the downside beyond fair value. And markets spend a lot of their time either above fair value or below fair value, whatever that is, because there's many different ways to determine the fair value of the market or individual stocks. But it's probable that the market will overshoot to the downside, and that's fine by me because it just makes the opportunity even better. Now, last week, this is what I said, and it's worth recapping. Stocks with fundamentals, with strong fundamentals, will lead the market recoveries. Now is the time to prepare. So that was the message from last week. This is the time to prepare, not when the media starts telling you that the bottom is in, because that's way too late. Sentiment has already improved for the media to say that. So preparation time is now. We started doing some buying judiciously the week before last, and I'll come back to that point because we actually had a pretty good short-term payoff as well. Waiting until the coast is clear is far too late. So they're all the things that I said last week. And at the end of Tuesday, when the US market had its third session up in a row, that was all looking pretty good at that point. However, the market has gone down again significantly since then. So what do? Well, I think the first thing to do is just to recognise where we're at the moment. The environment we're in is an opportunity, not a problem. That's the first thing you've got to do. You've got to start looking at the market as presenting us with some terrific opportunities. We may not be there yet, although we are definitely on a couple, but this is an opportunity that's building. Your cash and your exposure positions should have been adjusted many, many weeks ago. I think this is probably the 5th or 6th straight week that I've been talking about this valuation reset. So any adjustment should have been made a long time ago. Preparation now is critical. It's obviously still not too late because the bulk of the market is still going down according to what happened in the last 3 days of last week. Prepare now and then take advantage gradually. You don't want to be putting a lot of chips into the middle of the table because you're guessing at where the bottom might be. Just take it step by step and pick up great opportunities as they present themselves. Because there are wonderful growth businesses out there, there's no question about it, and I'll talk about that in a minute. So just do that. Just focus on the wonderful growth businesses, and some days the market rewards them and some days it doesn't, but that's okay. And just forget about the general market and what it's doing and all the media narrative that's going with that, because it can't do you any good. It can only possibly mess up your mind. And you don't need that. So just really, really narrow your focus and just do the things that work very well. And of course, that just leads into what I say every week, and that is that it really is easier to lose money in the market the way that most people do it. You need to get organised, you need to be prepared, and you need to have conviction about what you're doing. But for everybody else, make sure that you've got all of the advices that you need, financial, legal, etc., on board. Let's look at the American stocks. The S&P ended up down 1.5% for the week after having Monday and Tuesday being good sessions. And the Nasdaq was even worse, down by 2.4%, and I think it was over 3% just on Friday alone. The Russell 2000 dropped 1.65, and the equal weight S&P did a little bit better, down 1.2. So a lot of the heavy selling, the drag on the Nasdaq, came from stocks like Amazon and Google and Microsoft and Meta. They were the real drags. And those stocks are really getting down, in my view, into good value territory. Great outcomes are still being rewarded. Portfolio stock, I'll call it X because members are benefiting from that, so I'm not going to give the stock code away. But Portfolio stock X reported earnings on Thursday night after market, and on Friday it rose 20%, despite the fact that the Nasdaq fell 3.1%. And at one stage, that stock was up nearly 30% on the session. So good performances are still being rewarded. And that's something that you really should hang on to, because it's not as though the market is just shunning everything. It's not. It's clearly going to reward handsomely stocks that are doing well. The US dollar was unchanged at 104 and a bit. The 10-year yield edged slightly lower at 4.25, and the VIX back up above 20, again, 21.6. So let's go and look at some charts. There was the S&P. This is a daily, so you can see Monday and Tuesday were quite buoyant. Wednesday was a doji, undecided. And then, that was Friday. And then Monday was the first day up. We then had an indecision day on Tuesday. And then the rest of the week, it tumbled, and particularly on Friday. And there was no particular new piece of news that I'm aware of that precipitated that. It's just the sellers decided they wanted to get out. Now, if we look at the Nasdaq, last Sunday, I said I strongly doubt that this is the index low. This is a weekly chart, and that was pretty evident. You can see the first part of the week, we gapped higher, so a very positive open, traded higher, and then gave it all back and some by the close of the week. So we had a dead cat bounce for a couple of days, and then the Nasdaq got pretty well clobbered. If we look at this chart, which is very interesting, this is the S&P index versus the gold price in US dollars. And we hit this really, really important support and resistance level, because it picks up 1, 2, 3, 4, 5, picks up 5 touch points just since 2018. So that gives it more significance. So we bounced a little off there, but it was pretty weak, and we've crashed straight through it fairly quickly, fairly emphatically and fairly quickly. So that chart tells us what we already know, but sometimes it's good to see it. And that is that gold, a dropping ratio between the S&P and gold, tells us that gold is outperforming the S&P. Now, you might think, well, of course, we all know that. But it's really important to see just the rate of descent is dramatic. This is not a little bit of outperformance by gold relative to the S&P. This is very fast. So the rate is important, and the fact that we had almost no bounce in the ratio, just a couple of days and then a really important support level broke. This is the other one that's really important. This is consumer discretionary versus consumer staples. Again, we had a few days of respite, but it's been hammered again very, very quickly. And the speed of this is a comment I made a few weeks ago, the speed of this decline is really even greater than what we saw back in 2020, late 2021, which was a precursor to the NASDAQ going down pretty much throughout 2022. SMH is always important. I always keep a close eye on this. This is a weekly chart as well. And you can see that there's no question the character has changed. We had mainly green candles through here. We had one big red candle, and then we got back to green candles, so buyers in control. And then we got some significant red candles off the peak, bounced around for quite some time. So that occurred in the middle of July of last year. Then we've bounced around until we got into the latter part of February. And then since then, it's been pretty much all down. And 3 of the 5 weeks have been quite significant down candles of longer range, closing on their lows and on rising volumes. So all that tells you that the sentiment surrounding semiconductors, and semiconductors are so important for the overall sentiment of the market, that has shifted very negative. And therefore, and we've broken at the support level here. We've got another one coming up down here at 200. But it tells you that the sentiment and the character around semiconductors has changed quite significantly. And that cannot be ignored. Ignore that with your peril, at your peril. This is over the last month. The US main indices at the bottom, consumer discretionary, and XLK, which is technology. So probably no real surprises there, but they're a long, long way below the rest. So that's where the big underperformance has been. And of course, that's where the Magnificent Seven live as well, with Amazon and Google and Microsoft and Tesla, etc. Coming up the food chain a little bit, communication services, but that's still an aggressive sector. That's next to last. And then we start to get up into materials, banking and consumer staples, etc., healthcare. And then energy has managed to scramble back up to the top over the last month. If we look at the Australian market, then really only materials were positive over the last month or so. And we've got information technology clearly at the bottom. And a lot of that is due to some issues, particularly around WiseTech Global, but also that is mirroring what's happening in the States as well with respect to technology stocks. So that's the way that the money flows look in the market. And this is the Russell, of course, on a weekly chart, and it's starting to give ground pretty quickly. And if you look at the last 3-4 months since early December, it's nearly all red candles. There's not too many good weeks in there. So that's where we sit with the US market. Turning now to Aussie stocks, our dollar 62.28 was the finish. 61.3 remains a key level. Our index managed to gain 0.6% on the week, but that will disappear, I would think, on Monday. And we've got the valuation reset is very much alive and well here in Australia as well. And we're seeing a lot of the high multiple stocks that are great stocks. Their businesses haven't changed. It's just the market now is recognizing that a valuation reset is on globally. And the big names here that I think most people know are not being spared either. But look, the gold sector, certainly that was the outperformer, but coming in second behind the gold sector was some more defensive sectors around consumer staples. There was some good support there. But I do have to note, and members know this very clearly, that we've got a portfolio chock full of what I regard as absolutely outstanding growth businesses. And the majority of them, there's 1 or 2 that are looking pretty ordinary, but the vast majority of them, the prices have remained very resilient. the businesses of nearly all of them have remained in great shape. But there's some that have, I guess, succumbed to the market sentiment a little bit more than others, but the majority is still holding up pretty well. And I want to just go and focus on a couple of things there. We'll just look at the currencies first of all. So there's the US dollar, no real change at all last week, and the Australian market on a weekly basis, again, very little change in the Australian dollar. But looking at the Australian market, yeah, sure, we had a few losers last week, losers in the sense that stocks went down. We didn't necessarily get out of them, but the prices went down. But these are businesses that have got fabulous fundamentals and great outlooks. It's just that at the moment, the market is not recognising their merit at present. And that's just the way it is. It'll swing back at some point in time as long as those fundamentals hold together. But having said that, we had more excellent winners than we had losing stocks that detracted from the portfolio. Now, these stocks, or these businesses, had similar fundamentals as well, great fundamentals and outlooks, but the market is recognising that, and those prices either went sideways or went up. So it was a mixture last week for our portfolios, but this is how we think about our portfolio. So the lens that I use is, when I research a business, is, can this business grow their earnings at 20% plus per annum with a high degree of probability? That's the lens that I look through. Now, when you're doing this sort of research and you try to project into the future, then you're making assumptions. So there's nothing guaranteed about the outcomes. But as long as you can get the significant majority of them right, and they are growing at that sort of rate, then you worry about the few that don't make it as it comes along. So the majority are going to fulfill their promising outlook, but a couple won't. And we'll exit those when either the fundamental or the technical circumstances dictate. And we just don't worry about it otherwise too much. If we can get 70 or 80% of our situations over the medium to long term working out as planned, then they will more than compensate for the few losers that we'll get and do get. So that's the way that we look at the Australian market. And at the moment, I've got to say, it's pretty pleasing the way that it's working. There's the materials index on a weekly chart. It hasn't really changed for a few weeks. If we look at energy has had a couple of good weeks. The banks got sold off very heavily and then have rebounded. Be interesting to see what they do on Monday. But the real problem sector has been information technology. And certainly stocks like WasTec Global have fed into that. But it's also been just the valuation premium reset going on as well. While we're here, let's look at gold and silver. This is silver on a big picture chart. So we're back here in 2011. So this is about 14 years of history with silver, back to the last time that silver spiked and got to $50. So we've been down a long time, but you can see that the lows occurred around COVID, March of 2020. And then since then, we've had a couple of big surges. We had a really big surge here and then another one that we're currently in, and it's forming higher highs and higher lows. We just managed to break a tick above $35 to finish the week. And there's an important resistance level here at $35.30. So if silver can punch through there fairly emphatically, then we've got some pretty clear air, because silver's overcome an awful lot of overhead resistance on the way up. There's been so many points where there would have been more selling pressure. So let's just have a look at that on a daily chart. And you can see finished down a little bit at 34.09. In fact, that has changed since I looked at it prior to recording this video. Maybe the data hadn't updated. So you'll see on the slide that I had the close closer to 35. So that is silver, still looking very positive, higher highs, higher lows. This is US dollar gold price on a daily chart. We finished the week with two quite strong sessions and finished 3085. And if we put that on a weekly chart, you'll see just how positive the gold price move has been since about the middle of October. So we're almost up to 6 months now that gold has been running pretty hard. It's run from 1900 or 1850. So that was October 2023. We're at 1850 and now we're at 3085. Looking at this on the Australian dollar basis, again, weekly chart, incredibly strong. There's only been 2 weeks down since July of last year. The rest has been either a little bit sideways or strongly higher. So that's looking extremely good. And just to finish off with Bitcoin, Bitcoin got back up to 88,000, but then finished off the week dropping a few $1,000s. I think I've covered all that. So moving now to precious metals. So gold, $61 up, 3085, pushing $5,000 in Aussie dollars. So no wonder our gold sector is doing so well. Silver, that my charting package mustn't have been updated when I did that because we did close down a fraction, but it's still looking very strong. Now, according to Eric Sprott, and I guess he's talking his book, of course, but he's saying silver should be over $100 an ounce for varying reasons. Naturally, he's going to be positive, having one of the world's bigger precious metals funds. Another comment I picked up, which I thought was interesting from the CEO of AFSL, and that is that globally we consume around 1.2 billion ounces of silver, but we only mine about 1 billion ounces. So we're in a pretty significant deficit of a couple of 100 million ounces a year. Now, there is also a stockpile, but that stockpile is getting smaller. But one dynamic that we've got to be mindful of, so it's on the one hand, it's easy to get excited and say we're mining far less than we need. But as prices move up, more scrap comes to market. So it's not quite a simple equation as you might initially think. But if we look at long-term for gold in particular, so long-term perspective, if this was the first part of a bull market, and we only ever know for sure when we look back in hindsight, but I mean, it's pretty obvious that it is. If we're in the first part of a bull market, then that bull market started in August of 2019. And typically, these bull markets in gold have run for something like a decade, a bit more, a bit less, but that's not a bad round figure to use. So in that case, we've got numerous years to run. And I know that some people are thinking, well, I've missed the boat. Well, I don't think you have missed the boat at all, because you look at the environment that we're in at the moment with tariffs and global tensions on all sorts of matters, financial systems being stretched. The environment is as conducive for gold being in a bull market as probably we've ever seen. It doesn't guarantee that it will continue, but it certainly gives you a heck of a head start. So we've got a great environment for gold to keep running. History tells us that gold, once it starts in a serious bull market, is going to keep going for a lot longer than we've seen so far. Then if you look at stocks will normally amplify the gains in gold, and generally by something like 3 or 4 to 1. So if gold goes up 10%, then you can expect the average gold stock to go up 30 or 40%. But stocks have continued to trade at historic low ratios relative to gold. It's just the way it's been. So that, again, that doesn't guarantee that there'll be some catch up. But if we get another multiple years of higher precious metals prices and we get some sort of movement back in the normal ratio between stocks and gold, and also silver and gold, then we've got the probability, and that's all we've got in investing is probabilities. Then we've got the probability that there could be some extremely attractive investment returns in this area in coming years. And we're yet to see the margin expansion that really comes with this as well. I think the Australian stocks, maybe the bigger Australian producers, are starting to show it, but there's still a lot of upside yet in the markets for gold equities. And then on top of that, if you needed another driver, we've got this mergers and acquisitions army that's really starting to get into gear now, and that is going to inevitably move its way down the food chain. So it's a very rosy environment for precious metals. Turning to other commodities, copper hardly moved, neither did nickel. We had a breakout in copper and then a partial retest. And there could be some more downside in copper because the reasons for that breakout, it's quite likely that we've seen some front running before the US tariffs occurring in the US, expecting tariffs to be put on copper. And in fact, Trump has now signaled that it's going to be brought forward. And so if that was the majority basis for copper breaking out and hitting $5.25 or something close to that, then that could get given back pretty quickly. So just be a little bit careful with copper at the moment. Now, crude oil was up again very slightly. We've got an interesting situation where we've got supply tightening, but demand is also cooling as well. So it's just sort of sitting there in balance, as we'll see. This spot copper chart peaked, I think, at $5.23 and then backed off. So we've done the retest of the breakout of this significant peak we had over here. There certainly is some risk to the copper market. There's a very sad story of spot uranium. So that's not looking at all healthy. Crude oil also, we've got a little bounce, but we've been going sideways really since September of last year. So wrapping it all up now, from my perspective, as the index falls, the opportunities just get better and better. However, the majority of stocks are going to succumb to the sentiment. The majority of stocks will go down with the index. So therefore, there is a very high risk if you get it wrong. So you need to make sure that you get this right, that you're in the right sort of stocks that are going to fall less and turn around and start to go back up again quicker. So the homework has to be done well. If you don't know how to do it well, then get someone to help you. The execution windows are generally not large these days. Markets move very quickly because of information flow. And so you've got to be prepared early because you need to move quickly. You don't have weeks to think about this. The key is having conviction in the process that you use, not trying to be right every time because that's not possible, but just get on with it. Have a high conviction in your process. Make sure that the majority of the stocks that you're acquiring are the sort of stocks that will respond quickly. And just see the market clearly, see the opportunities clearly, and just get on with it and do it quickly. Portfolio Analyst this week is focusing on common mistakes that investors, which is really important. If you can't learn from your mistakes in the market, then you will be a victim of the market. And also, of course, leading on from that is how not to make those common mistakes. And most of it is just simple common sense. There's really nothing magical about success in the market. It's a lot about clarity and preparation. And if you can do those things, then you're going to be way ahead of most investors. That's it for this week. There's the website information and my email address, and I'll be back with you next Sunday. Cheers.